Hey everyone, my name is Alex Morgan. Right now, as you are watching this video, the price of gold is sitting at over $5,278 an ounce. Silver is trading near $92, and somewhere in the Middle East, the consequences of one of the most significant military strikes in recent history are still unfolding. Consequences that are hitting your savings, your investments, and the purchasing power of every dollar in your wallet, whether you realize it or not. This is not a drill. This is not a forecast. This is happening today, February 28, 2026. And if you have any money in the market, any retirement account, any physical metals, or any interest in where the economy is headed, the next 15 minutes of your life could genuinely change how you see everything. Let's get into it. Just days ago, the United States and Israel launched a coordinated military strike on Iran. The target was Iran's nuclear infrastructure, facilities that Western intelligence agencies have been monitoring for years, and which diplomatic talks in Geneva had repeatedly failed to neutralize through peaceful means. The strikes were not a surprise to everyone. Military analysts had been warning for weeks that the window for diplomacy was closing fast, and that the U.S. had moved 2 aircraft carriers, 12 warships, hundreds of fighter jets, and multiple air defense systems into the region. That kind of military positioning does not happen for show. When that much firepower gathers in one place, markets notice, and they move. And move they did. Gold, which had already been on an extraordinary bull run throughout 2025 and into 2026, surged with fresh intensity. To understand why, you have to understand what gold actually represents in moments like these. Gold is not just a shiny rock. It is the world's oldest insurance policy. When governments go to war, when currencies come under pressure, when the global supply chain faces disruption, gold is where the smart money runs. It has done this for thousands of years, and it did it again this weekend. As of today, gold is priced at $5,278.27 per troy ounce. To put that in perspective for you, just 1 year ago, gold was trading around $2,600. That is a near doubling of price in 12 months. And if you think that sounds dramatic, wait until you hear what the analysts are now saying about where it is going next. J.P. Morgan, one of the most powerful financial institutions on the planet, has officially forecast gold reaching $6,300 per ounce before the end of 2026. Other forecasters are even more aggressive. Some models, when you factor in continued central bank buying, ongoing geopolitical instability, and sustained dollar weakness, point to figures as high as $7,000 and beyond. One projection from a commodity research group puts gold's theoretical ceiling at $10,762 if the current macro environment persists. Now, nobody is saying that happens tomorrow, but the direction of travel is crystal clear, and today's events in Iran just poured jet fuel on that journey. So why does a military strike halfway across the world send gold prices flying in New York, Chicago, and Los Angeles? Let us break that down in plain English. When the United States engages in military conflict, especially in the Middle East, a cascade of economic consequences follows. First, there is the uncertainty factor. Markets hate uncertainty more than they hate bad news. A known outcome, even a negative one, can be priced in. But an active military conflict with an unknown duration, unknown escalation risk, and unknown global response? That is the kind of uncertainty that sends institutional investors sprinting toward hard assets. Gold is the hardest asset there is. Second, there is the dollar dynamic. Military spending is enormous. Wars are extraordinarily expensive, and they require government borrowing on a massive scale. When the U.S. borrows more, it issues more debt. When it issues more debt, the long-term value of the dollar comes under pressure. And when the dollar weakens, gold, which is priced in dollars, becomes more valuable almost automatically. This is a mechanism as old as modern finance itself. It happened during Vietnam. It happened during the Gulf War. It happened after 9/11. And it is happening right now. Third, and this is the one that affects gold and silver in a uniquely powerful way this time around, there is the Strait of Hormuz. Iran controls the geography around this narrow waterway, and roughly 20 million barrels of oil flow through it every single day. That is 20% of global oil consumption passing through a stretch of water that is, at its narrowest point, just 21 miles wide. Iran has temporarily closed the strait before, most recently for military drills in February of this year, and the threat of a full closure has sent energy markets into a panic. But here is what most people miss. The Strait of Hormuz is not just an oil route. It is a global trade artery for all commodities, including precious metals. Any disruption to that route creates supply chain shocks that ripple across every market on Earth. This is why gold and silver both spiked the moment the attack news broke. Now let us talk about silver, because silver's story right now is one of the most compelling and most overlooked financial narratives of our era. Silver closed Friday, February 27th at $92.06 per ounce. That is nearly $5 higher than just 24 hours earlier. And when you zoom out, it gets even more staggering. 1 year ago, silver was trading around $28 an ounce. Over the course of 2025, it made an extraordinary run, briefly touching an all-time high above $121 per ounce in the spot market before pulling back sharply. That kind of volatility, a 147% gain in a single year, is not normal even by silver's wild standards. And yet here we are. What makes silver different from gold, and what makes its current situation so urgent, is that silver is not just a safe haven asset, it is an industrial metal. Over 60% of global silver demand comes not from investors or jewelry buyers, but from manufacturers. Solar panels, electric vehicles, AI-driven data centers, advanced medical equipment, consumer electronics. Every single one of these industries, which are all growing at breakneck speed in 2026, requires silver, and there is simply not enough of it. The Silver Institute has confirmed that 2026 will mark the 6th consecutive year of global silver supply deficit. That means the world is consuming more silver than it is mining, year after year after year, 6 years in a row. When supply falls short of demand in any commodity, prices rise. But when that shortfall is structural, baked into the fundamental economics of the market, prices do not just rise temporarily, they reset to a new, higher baseline. That is what we are witnessing right now. This is not a spike. This is a structural repricing of one of the most important industrial and monetary metals on the planet. And now layer the Iran conflict on top of that already explosive supply-demand picture, and you start to understand why some of the most respected metals analysts in the world are talking about silver reaching $175 per ounce before this cycle is over. Alan Hibbert at Gold Silver said plainly that he would not be surprised to see silver gain over $100 from current levels. Russia, yes, Russia, has an active multi-year government program to accumulate $535 million worth of silver. When nation-states are stockpiling a metal, retail investors should pay very close attention. For the average American watching this right now, here is what this means in practical terms. If you have money sitting in a savings account earning 2% interest, while silver gains 19% in a single month, as it did this February, you are falling behind. Not because of anything you did wrong, but because of the macro forces reshaping the global economy right now. The Federal Reserve is stuck. Inflation is sitting at 3%, well above its 2% target, and the hot producer price index data that came out this week effectively killed any remaining hope for a rate cut in the first half of this year. Some economists are now whispering about the possibility of further rate hikes. In that environment, paper assets, bonds, savings accounts, even many stocks, struggle. Hard assets like gold and silver thrive. Speaking of stocks, the equity markets are under serious pressure right now from multiple directions simultaneously. The Dow Jones Industrial Average dropped 521 points on Friday alone, closing at 48,977. The S&P 500 fell to 6,878. The Nasdaq had its worst monthly performance since last March, dropping over 3% for February. Technology stocks were hit especially hard, with chip makers selling off after Nvidia's latest earnings failed to inspire the confidence investors were hoping for. Meanwhile, Iran war fears are pushing oil above $66 a barrel, adding a fresh inflationary input at the worst possible time for rate-sensitive equity valuations. The contrast could not be more stark. Stocks falling, gold rising, silver surging. This is the classic war trade playing out in real time. So where do we go from here? What happens next? Let us be realistic and look at this from multiple angles because nobody, not JP Morgan, not any hedge fund, not any government intelligence agency, knows exactly how this conflict unfolds. But we can map out the scenarios and what each means for metals. In the most bullish scenario for gold and silver, the conflict escalates. Iran retaliates, whether through direct military action, proxy forces in Iraq or Yemen, or a serious attempt to disrupt shipping in the Strait of Hormuz. If even 1 week of significant disruption to the strait occurs, we could see oil spike toward $90 almost overnight, inflation roar back globally, and gold blast through its all-time high of $5,595, possibly approaching 6,000 in a matter of weeks. Silver, with its higher volatility and dual industrial safe haven nature, could move even faster in percentage terms. A return to and break above $100 per ounce in that scenario is not a fringe prediction. It is a mainstream institutional expectation. In a moderate scenario, the conflict remains contained. Iran limits its response to diplomatic channels, proxy threats, and rhetoric. The US and Israel achieve their military objectives without triggering a broader regional war. In this case, gold likely consolidates in the 5,000 to 5,300 range, as some of the geopolitical risk premium is removed, but the underlying macro drivers, Fed policy uncertainty, dollar weakness, central bank buying, and inflation, keep a firm floor under prices. Silver holds above $85, supported by its structural supply deficit. This is actually the scenario most Wall Street desks are currently pricing in as their base case. In the bearish scenario for metals, which is the least likely but must be mentioned, both sides move quickly toward a ceasefire, a new diplomatic framework emerges within weeks, the Fed signals a hawkish pivot, and the dollar rallies sharply. In that world, gold could pull back toward $4,900 to $5,000, and silver could test the $80 level. But even that pullback would be a correction within a larger bull market, not a trend reversal. The structural case for both metals, central bank accumulation, supply deficits, dollar debasement, and chronic global instability, does not disappear because of a single peace agreement. Here is the bottom line, and this is the message that every American needs to hear, regardless of whether they have ever bought a single ounce of gold or silver in their life. The era of safe paper savings is over. When the world's most powerful military is engaged in strikes on Iran, when the Strait of Hormuz is a credible flashpoint, when inflation remains stubbornly high, when central banks in Russia, China, India, and dozens of other nations are quietly stacking gold at record pace, the old rules no longer apply. A savings account, a bond fund, or a domestic equity portfolio is no longer a sufficient hedge against what is happening in the world right now. Gold closed in on $5,300 today. Silver is nearly at $92. Both of those numbers were unthinkable just 3 years ago. Both of those numbers may look cheap 3 years from now. The data supports it. The geopolitics support it. The supply fundamentals support it. And today's events in Iran have just reminded every investor on the planet, in the most dramatic way possible, why hard assets exist and why they matter. Stay informed, do your own research, talk to a qualified financial advisor before making any investment decisions. And if you found this breakdown valuable, hit that like button, subscribe for daily market updates, and drop a comment below telling me, are you holding gold or silver right now, or are you watching from the sidelines? Because right now, the sidelines are getting harder and harder to justify. This is the market reality of February 28, 2026, and it is only just beginning.